Partnership formation and operations, problem 5. So this problem we got at the formation of a partnership. We've got jackfruit and lychee. They contribute, lychee contributes cash of $81,000. Jackfruit contributes stock. Jackfruit and lychee share profits as follows. Jackfruit 1/3, lychee 2/3. When the stock is sold by the partnership 4 years later for $87,000, jackfruit must contribute a gain. Jackfruit must recognize gain of how much? So always start with the partnership. We saw that in the previous problem. It's always important to start with the consequences of the partnership, and then from there, you then allocate out the results to the partners. Remember Form 1065, right? Partnership reports, ordinary business income loss, and also separately stated items on the Form 1065. So here, the partnership is selling stock that it owns. We have a Section 1001 sale or exchange, so we do amount realized minus the adjusted basis. What is the partnership receiving? That's the amount realized. Partnership's receiving $87,000. All right. Adjusted basis. So partnership tax law, remember, has its own special rules. When jackfruit contributed the stock to the partnership, no gain or loss was recognized by jackfruit or the partnership, because jackfruit was receiving an interest in the partnership and giving up property, so none of them had gain or loss. Remember, it's non-recognition rule, Section 721. Every non-recognition rule is a basis rule, and therefore the partnership and the partners take a carryover basis in the asset. So jackfruit takes a basis in his partnership interest of $2,000, right? Carry over the old basis. And the partnership takes a basis in the stock of $2,000. Therefore, the basis of the stock is $2,000 under the carryover basis rules. So the partnership has a gain realized and recognized of $85,000. So some of you might be wondering, or might be thinking, I should say, well, we saw in previous problems, the way we allocate is we use partnership agreement, and you're right, that's how we allocate, right? So 1/3 to J, or jackfruit, 2/3 to L. The only problem with that is that there's an anti-abuse rule found in the tax law, and it's known as Section 704C. And let me explain the issue, and then I'll explain how this works. Here's the issue. Let's say that jackfruit is a 30% taxpayer. They're both unrelated. And lychee is a 10% taxpayer. They're in a 10% tax bracket. Well, if jackfruit was to sell the stock, jackfruit would have recognized at formation rather than contribute to the partnership. Jackfruit would have recognized a $25,000 gain. Let's assume it was subject to a 30% rate. If lychee was to sell the stock, lychee would have a $25,000 gain at 10%. Which one obviously has the smaller tax consequences? Lychee, because lychee has a 10% tax bracket, right? So lychee would pay $2,500 in taxes rather than jackfruit. Jackfruit would pay $7,500 in taxes. So big difference in tax rates. Well, unfortunately, jackfruit owns it. So what taxpayers would do is they would create a partnership. They would put the property into the partnership, and the other partner would also contribute property. And then what happens is, based on lower tax rates, the partner would try to allocate gain to a partner that has a lesser rate, like here, L, lychee, the 10% rate, and that would then avoid tax because you'd have that 20% tax savings. And what J would do is pay the partner, hey, I'll give you the money for the tax, and I'll give you a little bit extra for your time and trouble doing this. And still, jackfruit would end up paying less overall in taxes than if J was to sell it him or herself. Okay? So Congress saw this was happening in the tax law. So they created Section 704C to put a stop to this. basically what Section 704C says, that if you have a built-in gain or loss, and what you look at for this is you look at date of contribution. So on contribution, if there's a built-in gain or loss, it goes to the contributing partner. It's stuck with them. It's allocated to them first. If the partnership later disposes of that property. So we have an $85,000 gain of the partnership. And that would be reported on Form 1065 and Schedule K. Okay? In determining how that's broken on the K1s of jackfruit and lychee, what we do is we apply 2 steps. Step 1, we allocate to jackfruit any pre-contribution gain here. We determine that by taking the fair market value minus the adjusted basis at contribution. So jackfruit's fair market value contribution was $27,000 minus the adjusted basis of contribution, which was $2,000. That equals $25,000. So that first $25,000 goes to jackfruit as pre-contribution gain. So that leaves us with $60,000 left, and that $60,000 is the second step. In that second step, we then allocate using the normal allocation rules, which again, we look at the partnership agreement. We do 1/3 to J, which is $20,000. 2/3 to L, which is $40,000. So in the end, jackfruit's share of the $85,000 gain is going to be $45,000. Right? That's the $25,000 in step 1, the $20,000 in step 2. L's share is going to be $40,000, just the $40,000 in step 2 because there's nothing in step 1. And that equals a total of $85,000. Because if there's $85,000 reported on Form 1065, there has to be $85,000 split up between or among the partners. And then we have exactly that. And that is how you allocate a pre-contribution gain or loss. The idea is that that original $25,000 of gain that happened on the day of contribution is allocable to jackfruit, but the increase in value above the $27,000 to $87,000 is attributable to the partnership. Right, that's the $60,000, and that's allocated under the normal rules.